All right, exciting times here today. We're taking our first call in. Young guy, Corey, right out of college, has $200,000 in his pocket. How do you get $200,000 in your pocket right out of college?
You know, I wish I knew the answer to that because,
oh, well. All right, stay tuned. Corey's going to call in. If you like what you hear today, make sure you subscribe. And, of course, you need to like this thing. So stay tuned. All right, thank you for tuning in, folks. Today we've got our first guest. His name is Corey. Corey lives in Los Angeles, wants to be a real estate investor, and is trying to figure out the path to get him started. So, Corey, thank you for calling in today.
Thanks for having me, guys. I appreciate you taking the time. So my situation is I just graduated college, got a couple $100,000 set aside, and just wanted to ask you guys some questions about commercial real estate.
Okay. All right. That's what's your first question?
I think the first one I have is, would I be able to hire a firm like you to manage my assets, and what entails that?
Well, to manage your assets, no, you don't want to hire a firm like that. You can hire a brokerage firm to go out and find you the properties that will then help you make your first investment. But as far as property management, you're going to want to take that step when it's time. And, I want to kind of warn you about hiring a property management firm, because I can tell you that when George and I bought properties around the country before, some of the properties we acquired because they were managed by a third-party management company, and they'd taken advantage of out-of-town investors. So Absolutely. You really want to make sure, if you're going to buy, and now I don't know if you're wanting to buy local or you're wanting to buy out of state, but I'd really like to see somebody that it's new that's investing. You want to be able to drive to that asset and see it, walk it, feel it, boots on the ground, until you really have a good idea of what you've got. Because if a property management company out of state knows that you're not experienced, there's a good chance they might take advantage of you. Yep. So.
And also, the beautiful part about commercial real estate is a lot of different asset classes or types of properties are designed for or set up for investors in mind, in that it doesn't require a lot of property management. It can be relatively passive depending on the asset class. I think the most labor intensive when it comes to the management side is definitely going to be multifamily, residential multifamily. But retail, and I have clients that own 40, 50 shopping centers that manage the entire thing with just 3 people. So it can easily be done even on a part-time basis for when you're starting off. And the best part about that is that you actually get the experience and understand, so that as you grow and get larger, and if you do need to hire a property management company because it's taking too much of your time from your core business, then you at least understand how things work, and you'll be able to identify those red flags ahead of time.
Well, I think, Corey, the first thing you really want to do is how much, what is your path for your investment? Are you looking to be a passive investor? Are you willing to go out and, if it's going to be multifamily, be out on the property yourself? What are you looking to do with your investment strategy?
Well, Joe and George, appreciate you asking. To be frank, I don't really know. I mean, I got about $200,000. And I guess, my biggest question might be, if you were in my position with that amount of money, what would your steps be? Where would you guys go with that?
I would say there's a couple things you can do here. Is with that amount of money, are you wanting to stay local, or are you going to want to go out of state? Are you willing to go out of state?
Yeah, I'm willing to go out of state. I mean, Los Angeles, as obviously you guys know, is pretty pricey. So, I think my money might stretch a little bit further in a place like, Texas or something like that. I don't know. Would you guys be able to handle something like that?
Yes, yeah, definitely. We have affiliates that are there that we can really, we can set you up. But there's one thing that I want you to think about. Have you looked at a real estate investment trust at all?
I have not.
Okay. Usually, and sometimes I should say, not usually, When I see a new investor and I meet them, I always want them to take a look at, if you're not sure of your strategy, maybe you should invest in a real estate investment trust first and really get a feeling of how it works. Because if you go ahead and do that, first of all, you start getting dividend checks right away with very little risk. But you also get to see the process because you're going to receive all the paperwork. You can be on the conference calls. You can really go that path. Now, if that's too passive for you, then George, what do you think would be a good investment?
Well, based upon what you're saying, what I like to look at, and here's how I approach investing with a lot of my clients. I first and foremost start off with, I am geographically agnostic, but extremely location driven. So first and foremost, location, location, location. Everyone's always heard that in real estate, but it really, for investments, it really plays a key part when it comes to the commercial real estate. For the price points that you're looking at, I think realistically speaking, and you're going to be able to do much better out of state than in California, I would almost look for smaller retail strip centers. The issues that you may run into yourself that are a little bit more personalized is based upon the down payment amounts. You can leverage up to about 65% on your LTV, so let's just call it up to about a $600,000 purchase price. One of the things that comes into play though is that with multi-retail centers without corporate tenants, and they typically have shorter lease terms, your financing may be an issue where you may have to personally guarantee the loans, in which case then you also need to show assets to be able to qualify for that loan. So since you just graduated college, I'm not sure if that's the best avenue or not for you. Or you can also go with a lower leverage, lower price point deals and work your way up, meaning look for deals that you can potentially reposition and or add value to, and then as you work on them for the first year or two, after you get the pricing up to where it needs to be and the tenants where they're at, sell them to buy something else that's larger, perhaps with a 1031 exchange, and you can also take some of the cash out yourself at that point as well, just knowing that you're going to have to pay some capital gains on it. So that's an opportunity. The other opportunity, which is still passive but a little bit less so than the REITs, is sponsorships. If you find a really good sponsor, and these are people who also called syndicators or syndications, where you have a sponsor who is typically a developer or an investor that has done this before, has a good proven track record, and you're playing off of that. So what they do is they sponsor a deal. Specifically, they may have one or two deals that they'll show you that they're working on right now. You can pick and choose if you like it or not, and then you can do an investment anywhere from, I've seen them as low as $50,000 to buy in. Actually, I've seen them as low as $20,000 to buy in. So you can then diversify out your risk. Only thing there is, typically speaking, if it's a syndication or sponsorship, it is going to be under what they call a PPM or private placement memorandum. And if you go that route, you do need to be able to show that you are a qualified investor, meaning that you have to have a certain amount of net worth as well as a certain amount of income. So depending on where you are in your job out of college, that is something, it sounds like you've done pretty well. You have a pretty good savings for most kids out of college. So that's good. But if you can show that you have the
well, you have to have
qualified investment purposes, like $1 million net worth of $1 million or income of $300,000 or more. If you can show that, then they can accept you under the syndication.
Now, Corey, if you do go that path, you really want to vet out the people that are syndicating the money.
The sponsors, absolutely.
Yeah, you want to do a lot of, ask for references, check on their history, and really vet them out before you invest with them. So,
ask if they've ever given any properties back to the bank, if they've had to negotiate a lower payoff or whatever. I mean, just find out what they've done. I mean, everyone's going to talk about their successes and how well they did on those, but also ask about the failures, because you know what? I can tell you that any investor out there, they've had a failure once or twice at least in their career if they've been in the business for any period of time.
Corey, another thing you might want to look at, if you would look at an ST&L for out of state, you can look for something that's a little bit higher risk. It's going to be a smaller franchisee or a mom and pop operator. But if you find a good location, signalized intersection, great traffic, that's something you might want to take a look at as well. And I know that's something that George specializes in, so he'd be good to talk to further about this. But that is, there's an opportunity there. But I get a little concerned when somebody as new as you are gets into multifamily, and if you're trying to buy out of state, more often than not, it's very difficult. It's very difficult to do. So if you're going to go out of state, then I highly recommend that you do an STNL or something like that, so you have a little less risk.
Yeah. Well, I think
I appreciate the tips, guys. I'm sorry to interrupt, George.
No.
But a question that me and my friends just kind of talk about a lot is investing together. And I think that for a young person is pretty common, sitting around with your group of friends talking about, future investments and, maybe going in together on something. As an ex-college grad who's just recently got out, it's something that, I don't have the most capital, and pulling in a friend or two might be able to kind of get me to a higher barrier. But I just kind of wanted to ask, what are the risks with that? And, what are the do's and don'ts when talking about investing with other people?
Yeah, that's a good one, because you want to make sure you people are all on the same path. Your investment strategy is going to be the same. Because if there's somebody comes to, let's say you buy an asset and you plan on a 7-year hold, and year 3 one guy goes, I don't want to do this anymore, then you're gonna have to buy them out. So you really want to make sure that the strategy is the same for every one of them. And if one of them says sweat equity, swear to God, run.
Yeah.
Sweat equity.
Well, what I would also recommend, in that situation, and I'm a firm believer in keeping things simple, or keep it simple, but at the same time, there are times when you need to make sure that you are looking out for, everything that may go wrong as well. So if you're looking at bringing in other partners, Joe's right on point when he says that make sure everybody is on the same page when it comes to the type of investment, what they're looking at, what their expected hold frame, time frames and whatnot. But life does happen and things may change. So you have to prepare for that. Make sure that you have part of the LLC is don't set it up yourself from, one of those companies that you can pay $200 and do it. But actually set it up with an attorney that knows what they're doing when it comes to real estate investments, and make sure that you have like what they call a buy-sell agreement in there. And there's multiple different avenues for buy-sell agreements. I mean, one of my favorite ones I like is that the person that wants out of the deal makes an offer to the other partners to buy them out, and the other partners have the option at that point to either let them buy them out, or if they think the price is too low, they can come back and buy the other person out for the price he offered. So it keeps everybody honest, and in addition to that, it allows for multiple avenues of exit strategies.
Yeah, it's.
I appreciate the knowledge, guys. Is this something I'm sure I'm going to have more questions down the road. I'm sure there's a lot of people out there like me, tuning in. That are going to have some similar questions. Is there a spot that I can, grab a bunch of these? Are you guys doing these calls a lot? Are you answering common questions, every week, or how does that work?
Well, the reason we started doing these, Corey, is I get these every day. So this works out pretty well, because we're driving everybody, we're recording this, and we're putting it on our YouTube channel. And so it's ideal for that. So any questions they have, feel free to call back. Let's keep talking about it. We'd love to help you get into where you're doing your investing, and then also I'll get your email at the end here, and I'll make sure that you have the link to the YouTube channell. Let me.
What is?
It's you can go to YouTube and just put under Joe Killinger, JoeKillinger, Or I have a website. It's joekillinger.co, joekillinger.co, and everything is there. We have blogs we put out as well. But there's one last thing before we go, Corey, and that is really think about your investment strategy. Where do you want to go, short term, medium term, and long term? And time frames and everything, because that's really critical to how you're going to be making your investments. So,
and if I can throw one thing in as well, part of that is determining your risk assessment levels. How much risk are you willing to take? Are you willing to go high risk for much more returns, for a bigger appreciation? Or would you rather see something that's a little bit more passive income, that's low risk, that's coming in? So you have to gauge that when it comes to your investment strategy as well. That should be a key part of it.
Well, guys, I really want to thank you for your time. I think I learned a lot more than I thought I would on this phone call. And I'm hoping other listeners out there can tune in and learn as well. So,
yeah.
Take the time. I will let you guys get back to your busy day. And I hope we talk soon.
Thank you, Corey. Have a good day.
Thank you, Corey.